The future of cash. Will paper money disappear in the digital age? Imagine waking up tomorrow and discovering that your wallet has become almost useless. You reach for your cash, but the store says, "We no longer accept paper money." You walk into a restaurant. You try to pay with a banknote. The cashier points to a screen and says, "Please scan the QR code." You take a taxi. You buy groceries. You pay your bills. You even send money to a friend. Everything happens through a phone, a watch, or a digital account. No coins, no banknotes, no physical cash. For thousands of years, money was something people could hold in their hands. But now, the world is moving toward a different kind of money. Money that exists primarily as numbers on screens. So what happens to cash? Will paper money disappear completely? Or will it survive alongside digital payments? And what could happen to society if almost all money becomes digital? This is the story of the future of cash and the transformation from paper money to digital money. The world of cash. For most of modern history, cash has been at the center of everyday life. People carried banknotes in their wallets. They kept coins in their pockets. Businesses stored cash in registers. Banks held physical currency in vaults. Cash was simple. You could see it, you could touch it, and you could exchange it directly. A person could sell vegetables at a market and receive cash immediately. No internet connection was required, no smartphone was necessary, no banking application was needed. Cash also provided something extremely important: privacy. When you paid with cash, the transaction did not automatically create a digital record connected to your bank account. For many people, that remains one of the strongest advantages of physical money. But cash also has disadvantages. It can be lost, it can be stolen, it is expensive to print, transport, secure, and manage. And as technology developed, people began looking for faster ways to move money. The beginning of digital payments. The transition away from cash did not happen overnight. It began with banking technology. Banks created systems that allowed financial information to move electronically. Credit cards changed the way consumers paid. Instead of carrying large amounts of cash, people could carry a small plastic card. A transaction could be recorded electronically. Then came automated teller machines. People could access their money without entering a bank during normal business hours. Later, online banking transformed the system again. People could check their balances from home. They could transfer money, pay bills, and manage accounts without physically visiting a bank. The internet had begun changing the meaning of money. Money was becoming less about physical objects and more about information.
The smartphone revolution. Then something happened that accelerated the transformation. The smartphone became a financial tool. Today, a phone can function as a wallet, banking terminal, payment device, and financial management system. People can transfer money within seconds. They can scan QR codes. They can use mobile payment applications. They can pay with digital wallets. And in many places, contactless payments have become part of everyday life. The important change is not simply that people are using phones. The deeper change is that physical money is becoming less necessary. Imagine buying coffee. Instead of taking out a banknote, you tap your phone. Instead of receiving change, the exact amount is transferred digitally. The transaction takes seconds. For businesses, digital payments can also make accounting easier. For customers, they can be convenient. And for financial institutions, digital transactions generate enormous amounts of information. This creates opportunities, but it also creates concerns.
Why people are leaving cash behind. Why are people increasingly choosing digital payments?
The first reason is convenience. You do not need to carry a wallet full of cash. You can pay using a phone or card. The second reason is speed. A digital transaction can happen almost instantly. The third reason is accessibility. People can transfer money without physically meeting one another. And the fourth reason is the growth of online commerce. When you purchase something from a website, cash is usually not an option. Digital payments are built into the system. As more economic activity moves online, digital money naturally becomes more important. But cash still has advantages. It does not require electricity, it does not require a network, and it can often be used without a bank account. That means the future of money may not be as simple as cash versus digital. It may become a question of how both systems coexist.
The decline of paper money. In some countries, cash is already becoming less common. People increasingly use cards, mobile wallets, bank transfers, and QR payments. Businesses may prefer digital transactions because they reduce the need to handle physical currency. Banks may also encourage digital banking because electronic transactions can be cheaper and easier to process. But the decline of cash raises an important question. What happens to people who depend on cash? Not everyone has a smartphone. Not everyone has a bank account. Not everyone has reliable internet access. Some elderly people prefer physical money. Some communities rely heavily on cash. And during technological failures or emergencies, cash can become extremely useful. So even if digital payments continue to grow, completely eliminating cash could create new problems. The rise of digital currencies. The next stage may be more significant than simply replacing banknotes with smartphone payments. Governments around the world have been exploring central bank digital currencies, often called CBDCs. A CBDC would be a digital form of a national currency issued or backed by a central bank. Imagine having digital dollars that are not simply money held in a commercial bank account. Instead, the currency itself could exist in a digital system operated under the authority of a central bank. This raises fascinating possibilities. Payments could potentially become faster. Cross-border transfers could become easier. Financial systems could become more programmable. But CBDCs also raise serious questions. Who controls the system? How much privacy would citizens have? Could transactions be monitored? Could governments restrict certain payments? And what happens if the technology fails? The future of money is therefore not only a technological question, it is also a question about freedom, privacy, and power. Cryptocurrency changes the conversation. While governments explore digital currencies, another form of digital money has already challenged traditional financial systems: cryptocurrency. Bitcoin appeared in 2009. Unlike traditional national currencies, Bitcoin was designed to operate without a central authority controlling the entire network. Its transactions are recorded using blockchain technology. Supporters believe cryptocurrencies can provide financial independence and create alternatives to traditional banking. Critics point to volatility, regulation, security risks, energy consumption, and questions about everyday usefulness. Regardless of the debate, cryptocurrency changed an important idea. It demonstrated that people could imagine money existing entirely within digital networks. No paper, no coins, no physical bank vault. Just software, networks, cryptography, and users. The definition of money was being challenged once again. What happens when cash disappears? Imagine a world where almost every payment is digital. You wake up. Your salary arrives electronically. You buy breakfast with your phone. You take public transportation using a digital wallet. You pay your rent online. You purchase groceries without touching cash. At the end of the day, almost every financial activity exists as a digital record. This could be incredibly convenient, but there is another side. If all money becomes digital,
financial systems become more dependent on technology. A major network outage could disrupt payments. Cyber attacks could become more dangerous. Technical failures could affect millions of people. And privacy becomes a much bigger issue. Cash allows people to make transactions without creating the same kind of permanent digital trail. Digital money can potentially make financial activity much more traceable. That creates a difficult balance. Convenience versus privacy. Security versus freedom. Efficiency versus independence.
Will cash completely disappear? So will paper money disappear? The answer is uncertain. Cash may become less important, but less important does not necessarily mean completely extinct. Paper money could survive for specific purposes. Some people may continue using it because they prefer it. Some businesses may continue accepting it, and governments may preserve cash as a backup payment system. Cash can also become especially valuable during emergencies. If electricity disappears, if internet networks fail, if payment systems stop working, a physical banknote can still be exchanged. This gives cash a unique quality. It is a form of money that can operate independently of digital infrastructure. So perhaps the future is not a world without cash. Perhaps it is a world where cash becomes a smaller part of the financial system. The future of money. The future of money may look very different from the past. Your wallet may become a smartphone. Your bank may become an application. Your credit card may disappear into a digital wallet. Your identity may become connected to financial systems. Payments may happen automatically. Artificial intelligence may help people manage spending, investments, and financial decisions. Digital currencies may become more common, and physical cash may gradually become less important. But underneath all this technology, one thing will remain unchanged. Money only works because people trust the system. A banknote has value because people believe others will accept it. A digital balance has value because people trust the financial institutions behind it. A cryptocurrency has value because users believe in the network and its rules. The technology changes, but trust remains the foundation. The end of cash, or the beginning of something new. For thousands of years, money has constantly changed. We started with barter. We developed objects that could represent value. We created coins. We invented paper money. We built banks. We introduced credit cards. We created electronic banking. And now we are entering an age of digital money. The banknote that once represented wealth in your pocket may eventually become less common. The wallet may become a screen. The bank may become an application. And money itself may become almost completely invisible. But perhaps the most important question is not, will cash disappear? The real question is, what kind of financial system do we want to build? A system that is faster, more convenient, more secure, more inclusive? Or one that gives people stronger privacy and greater control over their own money? The future will likely involve a mixture of technologies. Cash may survive. Digital payments may dominate. Cryptocurrencies may evolve, and governments may introduce new forms of digital currency. One thing is certain: money will continue to change. Because money has never been just paper. It has never been just coins. It has never been just numbers on a screen. Money is a system created by human beings to exchange value. And as technology changes the way we live, it will also change the way we pay. The age of paper money may not be over yet, but the age of digital money has already begun. This is the future of money, and the next chapter is being written right now.